Hello, everyone. Welcome back to another episode of Signal or Noise, episode 77. Charlie Bilello here, and with me, as always, Peter Mallouk. Peter, this is hard to believe here, but we've been doing this podcast a little over 3 years, and this will actually be the 9th $1 trillion milestone for the U.S. national debt. We just passed 40 trillion, as you know, last week, and I expected to do this episode this year. I just thought it would be later in this year. My target was actually October, but because of just a huge spending binge since July 1st, here we are in August talking about this. Just to put this in perspective here, $650 billion increase in the U.S. national debt since July 1st. Absolutely stunning. Not something you want to see, breaking a record in the wrong direction. So what are we going to discuss today? The $40 trillion question, Peter. Is America headed for a debt crisis? And I really broke this question down into 10 different parts. These are questions that I'm getting from advisors, from clients, from people on X. So I broke it down here. You and I are going to try to address as many of these questions as we can. Let's begin, first of all, with how we got here. And this chart really tells an important story, doesn't it?
Yeah, I mean, like basically the federal government spending versus tax revenues, there's no other explanation for this. There's this constant debate, oh, we're not taxing people enough, or are we spending too much? And we have reached a point where it's not even a real discussion anymore. It's impossible to tax your way out of this now. The debt is running away so much for a simple reason. We spend infinitely more than we collect, no matter how much we collect. Congress and the president have shown, regardless, Democrat, Republican, whatever, they've shown over and over again, even if they get more tax revenue, they will spend disproportionately more above that line. And it's causing a problem that is on the brink of becoming permanent.
So this is something we advise our clients strongly against, doing this at the household level, right, Peter? You want to try to save. You want to try to spend less than you're taking in. That allows you to invest in your future. Here we're doing the exact opposite, and just put math here, the numbers here to it. 65% is the increase in the revenue, so what's coming in the last 10 years. So we're actually generating 5.3 trillion a year. But problem is we're spending in the last year at least 7.3 trillion, and that part has actually increased 96% in the last 10 years, so almost doubling. So if you just continue to compound this going forward, $2 trillion deficit, and some are projecting it's going to increase from here, that's going to lead to an increase in the national debt. And you and I will be talking about another milestone in a few months unless this picture changes. But let's talk about number two here. This is a question we often get. Is one party to blame? Is it the Republicans' fault? Is it the Democrats' fault? What's your take on this, Peter?
I mean, it doesn't matter. In general, everyone's spending more than is coming in. I mean, Biden just shattered the record for deficit spending, and then Republicans were complaining about it. And then Trump, not to be outdone, quickly shattered Biden's record. This is a bipartisan issue. It's quite simple. You know, you get a credit card when you're the president, and you get to spend, and someone else has to pay the bill. So you're getting all the goodwill. You're making your military partners happy, or the social benefits partners happy, or some industry happy, and you don't have any consequence for it. The consequence gets paid by somebody else down the line. They get stuck with a credit card that somebody eventually says, hey, we're not putting any more credit on this credit card.
Why do you think the American people continue to be fooled? So on X, I've been outlining quotes from all of these presidents, Peter. They each one promised they were going to do something about the national debt. They would try to balance the budget. Every single one of them failed to do so. Why do we keep believing that they're actually going to do something about it?
I think there's not a lot of incentive in a democracy to do it, because most people can't comprehend. They don't know what the national debt is. The numbers are too big to comprehend. We've been hearing how horrible it is for 20 years and nothing has happened. So people go, well, it doesn't really impact me. And in a world full of sharp edges and anxiety, there's 10 million other things that are more pressing to worry about. This is one of those things that is not a problem until the second it becomes a problem. And then it will be at the top of everybody's list.
Okay, let's go to number 3 here. Will the U.S. default, and should I sell my Treasury bonds? And I just want to read this quote from Alan Greenspan. The United States can pay any debt it has because we can always print money to do that. So there is zero probability of default. Do you agree with Alan Greenspan here?
I mean, theoretically, yes, the government can print more money and then hand it back to the people that it's owed. But if you do that a lot, the money becomes worthless and it doesn't matter what you're actually paying them back with. If there was a real collapse, yeah, they'll print more money and pay you, but it would essentially be worth nothing.
Okay, how about the second part of this in terms of treasury bonds? It's a major portion of most
Yeah.
people's bond portfolio. Is this fear overdone here?
I do think that the Treasury is the single safest investment in the world. If you're loaning money to the federal government of the United States of America, they're going to tax people, they're going to print money. If that goes to zero, the world, I mean, we're talking about global anarchy, is probably what would be happening at that level. Money might be the least of everyone's worries. So if the United States became insolvent, nothing else works. Loaning money to your state or a county in the form of a municipal bond doesn't work. Loaning money to a corporation like McDonald's doesn't work. Loaning money to your friends or private businesses through private credit funds doesn't work. Loaning money to China doesn't work. This is the single safest investment in the world, and it's why it's so important that we kind of try to get this right.
Yeah, for sure. And I would actually say that we're actually in a better place today, much better than we were back in 2020 when interest rates were approaching 0%. If you're buying a bond today, the average bond is yielding close to 5% in terms of treasury bonds. You're going to get a higher return. The question is, well, how much is the inflation going to eat out of that return? But much better to be buying a bond at a 5% yield than a 0% yield.
Yes.
Let's talk about interest rates here. And big story last week, Peter, was that interest rates, 30-year Treasury bond yield moved up to 5.3%, highest since June 2007. Are these things related, or is this just a coincidence we're seeing the highest interest rates in 19 years?
Well, I think there is a lot going on here. One, a lot of the world hates the United States. So while they think that Treasury is the safest investment in the world, do you really want to lend money to a country that is imposing tariffs on you, or threatening to make your country the 51st state, or threatening what's going on in your region? There's a lot of countries are just looking for other places to put their money, and some of them are doing that in gold. And the US then has to pay more to get people to lend money to it, which is part of the reason we're seeing the higher rates. What's your take on this, Charlie?
It's complex. It's for sure is one of the reasons. If you flood a market with supply, Peter, it's going to be harder to sell that. So you're going to need a higher interest rate in order to sell as many bonds. But there's many factors that go into the interest rate, right? It's different flows. It's interest rates from other countries around the world. It's inflation and inflation expectations. So definitely, it's one of the causes. Is it the only cause? Definitely not, right? We're at a much higher debt level today than we were in 2007. Inflation seems to be more of a problem today, and yet we're at the same yield. So clearly, it's not the only factor, but definitely for sure it's a factor. And the more supply that comes out in terms of more debt, the harder it is going to be to keep selling it at the same interest rates. Eventually, investors are going to demand a higher rate. Let's go to this question here about the interest on the debt. Because we're now at 1.37 trillion, Peter, in the last 12 months. That's another record high. You could see the trajectory here. It's been moving not vertical, but rapidly higher because we have a rapid increase in the national debt and we have much higher interest rates over the last few years. And we now actually spend more on paying that interest than we do on actually paying for national defense. If we continue at this pace, it's actually going to exceed what we spend on Social Security within a few years. Social Security is currently the highest line item on the budget. So first, this question here I get from a lot of people: how are we paying interest on the debt if we're running this huge deficit?
We're printing money, right? We're just printing more money, which diminishes the value of the dollar and creates inflation.
Is there a trajectory to this where you could see this improving, absent some action that lowers spending or raises revenue somehow? How else could this chart essentially stop going up and to the right?
I mean, there is a school of thought that AI will make everyone so efficient that it will create so much wealth and there will be so much tax revenue that it will solve this problem. And I would love for that to be true. What's your take?
Yeah, let's save that for the growing our way out of it question. But No, I think the math here is pretty simple. Unless you reduce the deficit and slow the pace of increase in terms of national debt, this chart continues to go up. And
Yeah.
we're going to talk about growing our way out of it. We'll talk about should we try to manipulate rates in a little bit, but absent those types of things, this is going to go much higher. And I would argue it's not anywhere near a level today, Peter, that's actually a crisis. So what we're simply doing is just borrowing more money to pay the interest on the money we owe. And it's not yet at the point where this is so alarming that people are talking about it and say, I'm going to vote my congressman or senator out of office because of this chart. If it goes a lot higher and it starts crowding out other things that they can spend money on, if they're talking about cutting Social Security or cutting Medicare, and then very quickly people are going to care about this chart. But let's answer this question here, because we know we're moving closer to a crisis, Peter, but always the question is, well, how you know it? Is there a breaking point? Like debt to GDP level is something people often look at. Is there a certain percentage where it's going to be the point of no return, where you're just going to see an immediate collapse?
What's your take on this, Charlie?
I don't believe so. If we look at other countries around the world, I don't think there's going to be an announcement. We're broke. We're going to default. We've hit 150% or 200% in terms of debt to GDP. It's just moving in the wrong direction. So if we
Yeah.
look at countries like Japan, you're above 200%. Italy is higher than this, and not to say that they're in a good place. They're having their own issues, but there's no exact number. Every country is different. And you often talk about a lot of the benefits the US has in terms of still being viewed as the reserve currency. We could debate whether that's not going to be true anymore, but our economy and our tax base that we have in terms of the ability to increase revenue if we need to, all those factors, I think there's no exact breaking point. You just don't want to see this go materially higher.
I agree with that.
Okay, let's talk about this here, Peter, growing our way out of it. So in January 2025, new administration, President Trump, Scott Bessent, they were very adamant that we really didn't need to worry about the size of the national debt. At that point, I think it was 36 trillion when they came into office there, because we're going to grow our way out of it. We're going to have, I talked about numbers, I think 5 or 6% real GDP is what they were projecting. And if they did that, they said, well, then the growth would be so tremendous that the revenue from that growth would be so tremendous that the budget would be balanced just from that. And then you would start actually paying down the debt. This is the argument they made in January 2025. You could see what's transpired since then. 2025, we had 2.1 real GDP in the first quarter of this year, 2.1%, and the second quarter, 1.5%. What did they get wrong here? And is it possible at this point to grow our way out of it?
I think it's possible, and AI may be the key. It just creates so much profitability, so much efficiency that it creates so much in tax revenue that it solves a lot of this problem. A lot of people like Elon Musk have that school of thought. I'm not convinced, but I'm hopeful. We'll see.
The math would seem to be very difficult, though, Peter,
Yeah.
if you break it down in terms of how much more growth that you would need to generate. And with each step higher in the national debt, I think then you need higher and higher growth. So we seem to be at a different place, I would say, than post World War II, where we essentially did grow our way out of it. Not that the national debt went down, it didn't, but the debt to GDP ratio trended down for decades after that because our growth rate was far in excess of the growth in the debt. Number 7 here, what would an actual debt crisis look like? So there's no one thing. It's going to be a combination, I think, of a lot of these factors: weak Treasury auctions, sharp rise in interest rates, and people are talking about rates today. I think they're going to be much higher when there's an actual crisis than today. 5.3% is still considerably low, not an actual crisis. Persistent dollar weakness in terms of the US dollar relative to other currencies, rising inflation, a debt spiral where it becomes almost impossible to pay the interest on the debt, which kind of feeds on itself, and foreign buyers pulling back. Of these things, what are you looking at to tell you we're not just moving closer to a crisis, we're in a crisis, and maybe the government then would act?
I think we're going to have to see interest rates go substantially higher. A lot of foreign governments and big enterprises, less willing to loan to the U.S. government. I think a real crisis would be that a real alternative emerges. In other words, another country has a currency strong enough that everyone has confidence investing in it. That is, to me, would become the tipping point. We don't have that real alternative right now.
Yeah, and I think what you're saying there is the dollar would really be collapsing against that other currency, which would lower our purchasing power. Inflation is spiking. And then the question, Peter, I think when that arises, you have two paths you can choose. One would be austerity, right? You're going to pull back spending dramatically to try to solve it that way, or two, you resort to money printing and other shenanigans. Which of those two you think is going to be more palatable for politicians at that point in
Americans
time?
are not built for austerity, and any politician that tried that would be voted out instantly. So that would be the measure of absolute last resort. It would only happen where a politician could make the case only because of this is your money not worth zero, right? It would have to be that kind of last option.
Yeah, I think that's right, unfortunately, and we're getting a little preview of that today because we have this debt situation. We know we're moving closer to a problem here, and instead of the federal government kind of acknowledging, yeah, we're in a bad place, we need to do something about it, we need to rein in spending here, move closer to a balanced budget. Instead, what the Treasury announced last week, I'm sure you saw this, Peter, was that they're going to try to manipulate interest rates and drive them lower. They're talking about potentially using a $1 trillion general account, which is money that, of course, we borrowed substantially, to use that to buy back long term bonds and essentially hide the problem in the short run. So, why can't the federal government just do that, or the Federal Reserve just go in and buy up this debt and lower interest rates? We saw the Bank of Japan do that for a long time. Obviously, now they're reversing that action. But a lot of people ask that question: why isn't this a good idea? Why can't they do that?
You're going to have to tell me. You're going to be better than me at this one.
Well, I think the question of can they do it? Yes,
Yeah.
absolutely they can. Right? There's no question. The Fed could come out tomorrow, and President Trump has been pushing the Fed to do this. Cut interest rates to zero. He's saying Switzerland has
Mhm.
rates close to zero. Why shouldn't we cut interest rates? And that would lower the interest expense, right, on the debt. And at the same time, we could flood the market with demand and buy up these bonds, drive it lower, do what the Bank of Japan did for many years. They actually had negative interest rates because they created so much money and drove interest rates lower. The real issue with that, Peter, is that it really not only delays the inevitable, it causes more of a problem because it incentivizes the government then to do more of what they're doing, right? If there's no cost to that debt, if they're not paying all of that interest, what are they going to do? They're probably going to borrow more. So the thing that's kind of holding them back from doing that today are the higher interest rates. So I'd argue that's actually a good thing. And the Fed should actually be raising rates because of higher inflation and because of this problem. And then maybe we would get closer to a solution. Does that make any sense, or is that a
That makes more
fantasy
sense
world?
than I would have come up with.
Okay, so let's talk about the stock market because this is confusing for a lot of people. Saying if it's such a problem, if we're moving closer to a crisis here, why is the S&P and other stock markets around the world hitting record highs?
So the stock market only cares about one thing, and that's future expected earnings. If you're buying stocks, all you care about is how much money is that company going to pay back to you over a period of time. Interest rates impact that. If a company's borrowing money and they're paying a higher interest rate, they have less profits. Just like if you have a mortgage that's higher, you have less take-home money. And if interest rates are lower, there's more profits. But interest rates are just a function of the profits. And the only other way the market would price in the debt is if they thought there was an imminent crisis, which there's not. And debt spending is actually inflationary, which helps asset owners. The more money there is out there chasing the same amount of things, the prices go up. And we've seen more of that than ever. Post-COVID, under Biden and Trump, we see this record spending. And that record spending has resulted in very high inflation.
Yeah, and I think that absolutely on point there. But what you don't hear from these corporations pretty much ever is them talking about the national
Yeah.
debt. And I think they don't talk about it, Peter, because of the dirty little secret that in the short run, it's actually good for them, as you
Oh,
said.
that's right. Huge boost for asset owners for
I mean,
stocks.
So the people are going to have to pay this back at some point, one way or another, either through inflation or through austerity or taxation, some way. But in the short run, there's just more money in the system, right? So defense companies are benefiting, consumer companies are benefiting during that COVID stimulus. Everybody's benefiting in the short run from the government taking on more debt. And what I always say about corporations, it shouldn't be confusing that they're hitting record highs here because of earnings, but they operate totally different than the federal government, which is to say that not only do they balance their budget, they're operating to maximize profit. So they're taking in way more than they're spending, Peter. And the projection for this year is actually a 33% increase in earnings. If that happens, it would be unprecedented for this late in the cycle. But that's the number one reason why stocks are hitting all-time highs. Earnings are expected to explode. They have been exploding. And these companies are actually benefiting in the short run from that increase in national debt. Number 10 here, Peter, signal or noise. So the national debt in the last 10 years has gone up 106%. It's moved from 19.4 trillion to now 40 trillion. Is this a signal for investors or simply just noise? And I want you to break that down here between the short run, let's say the next 3 to 5 years versus the long run, 20 years from now.
Over the short run, as a crisis, it's noise. Over the long run, as a crisis, it's definitely a signal. Over the short run, it's inflationary. The extra spending helps being an asset owner. So it's a signal to stay positioned that way if you could ignore the short-term volatility. And I think that's generally how it shakes out. What's your take, Charlie?
Yeah, and agree. You absolutely shouldn't be viewing this number, 40 trillion, and we're going to hit 41, and you and I will talk about that at 42 and on and on and on. The number itself is not a signal to do anything. And in the short run, we can manage with $2 trillion deficits. It's not optimal. We certainly don't want to see that increase. It's not optimal. We want to see it go down, but it's not going to create a short-term crisis. The long run, what I'm talking about, your kids, my kids, our grandkids, they will face problems. We don't know when because of this if it's not changed. And that's why I hope, Peter, I'm doubtful given the history here that it's going to play out this way, but I hope that we act before it gets to an actual crisis that we talked about, before we get a weak auction, before we get all those things that we talked about. I hope they act, because at that point, it's going to be much harder to turn this thing around than today. I'm still optimistic and say this can be turned around if enough people care about this issue and just simply say, we can't do it anymore. Let's just be prudent here. We're not in a recession, Peter. We're in an expansion. Why do we continue to spend as if we're in an economic downturn? Is that wishful thinking?
It's a potential outcome. I put it at 60-40, and I hope you're right.
All right. Great discussion, Peter, as always. And we will revisit this at 41 trillion. Hopefully that won't happen this year. Hopefully it'll be a 2027 discussion. If you're watching this and you're thinking about your portfolio, thinking about the national debt, interest rates, how you should position yourself going forward, we're here to help with all of that and more. Reach out to us today at creativeplanning.com/Charlie. At Creative Planning, we're in all 50 states and abroad as well. So we likely have a location right near you. Over 780 billion in assets under management and advisement. We're here to help. So reach out today, creativeplanning.com/Charlie. Thanks everyone for joining us today on Signal or Noise. If you're watching this on YouTube, hit that subscribe button. We're also available on Apple and Spotify. And Peter and I will see you next time on Signal or Noise.